Overnight, the bouncer at, one of Wall Street's most exclusive dividend clubs just threw 22 massive companies right out into the alley.
Hmm.
And no human made the call.
Right, not at all.
Yeah, a cold calculating algorithm just triggered a near 25% turnover in the Schwab U.S. Dividend Equity ETF, which most of you probably just know by its ticker, SCHD.
Which means, if you're holding this incredibly popular 100-stock portfolio, you basically woke up today to a fundamentally different investment vehicle.
Exactly. It is Monday, March 23, 2026, and the mission of our deep dive today is to unpack this brand new reconstitution. We're looking at what got added, what got ruthlessly cut, and what this extreme algorithmic makeover actually means for your wealth building strategy.
And there is a lot of ground to cover.
Oh, a ton. I've gathered a massive stack of sources to break this down for you. We've got the official Dow Jones Index methodology, analyst predictions from the Motley Fool, some deep dive financial analysis from YouTube, specifically the Dream Green Show, and of course, the raw, unfiltered investor sentiment from the SCHD community on Reddit.
Well, to truly understand the impact of today's changes on your portfolio, we have to look closely at the mechanical, emotionless rules that dictate this fund's every single move.
Yeah, the mechanics are what protect the investor.
Exactly. But there's a lot of confusion out there about what actually happened today. We first need to define the difference between a simple rebalancing and a full-blown reconstitution.
Okay, so the best way to look at this, I like to use a fantasy sports analogy. A quarterly rebalancing, which the fund does 4 times a year, is just, tweaking your starting lineup.
Right, just adjusting the weights.
Yeah, exactly. The fund's rules state that no single stock can exceed a 4 or 5% weighting, and no single sector can exceed 25%. So quarterly rebalancing just trims the winners to keep everything under the salary cap, basically.
But a reconstitution, however, that is the annual March off-season draft. That is where the entire identity of the team can shift.
Where players are just cut entirely.
Right. Players are cut, rookies are drafted, and the baseline criteria to even be considered for the team are brutally enforced. The Dow Jones U.S. Dividend 100 Index relies on incredibly strict criteria.
Yeah, I was looking at the index rules, and it's fascinating how binary the entry requirements are. To even get past the front door, a company needs a minimum of 10 years of consecutive dividend payments and 5 years of consecutive dividend growth.
And that consecutive aspect is the primary filter against the yield trap.
Catching the falling knife.
Right, because a yield trap occurs when a company is secretly failing, and its stock price plummets. Because dividend yield is just the annual payout divided by the share price, a 50% drop in stock price artificially doubles the yield percentage.
Oh, so to a naive screener, a failing company suddenly looks like a gold mine.
Exactly. The 10-year payment rule, combined with that 5-year growth mandate, acts as a shield to prevent the fund from buying into those failing companies.
Which perfectly explains this situation with Wells Fargo, ticker WFC. The YouTube analysis brought them up as a prime example of a company locked out by these rules.
They're an interesting case.
Very. I mean, Wells Fargo has an amazing 25-year history of paying dividends. Their stock price is up over 119% over the last 5 years. Massive market cap. But they cut their dividend during the pandemic era economic turbulence.
Like a lot of companies did.
Yeah. And they've been aggressively growing it again recently, but they only have 4 years of consecutive dividend growth as of today.
And the algorithm demands 5.
Right. It completely removes the human context of a global pandemic. It just reads, the data 4 is less than 5. They're locked out.
But passing that initial 10-year payment and 5-year growth test, that merely gets a company onto the preliminary list. They then have to take a really rigorous math test.
The composite score.
Yeah, the algorithm creates a composite score based on 2 crucial metrics: free cash flow to total debt and return on equity, or ROE.
So let's translate those metrics into everyday mechanics for a second. Free cash flow to total debt is basically a household budget check.
I like that.
Yeah. Imagine a homeowner who makes $10,000 a month. Sounds fantastic on paper. But if there are mortgage, car payments, credit card minimums, if all that eats up $9,500 of it, their free cash flow is terrible.
Right. They have no wiggle room.
Exactly. If they promise to give their friends $1,000 a month, which represents the corporate dividend, they're going to have to put it on a new credit card. So the algorithm uses the cash flow to debt ratio to ensure the company actually has the liquid cash on hand to pay the dividend without borrowing money to do it.
Adding to that, return on equity measures how efficiently the company's management is using its capital to generate profits.
Right, how well they're reinvesting.
Yes, exactly. If a company retains a portion of its earnings instead of paying it all out, ROE tells us if they're reinvesting that money wisely to grow the underlying business. The algorithm ranks all the eligible stocks based on these composite metrics alongside their overall yield and 5-year dividend growth rate.
So it's a relative ranking system. A stock doesn't get cut from SCHD just because its underlying business is failing.
Oh, no, not at all.
It gets cut because 100 other companies scored better on this specific math test on this specific day.
Which brings us to the massive imbalance created during last year's reconstitution and why the algorithm reacted so aggressively today.
Oh man, the ghost of 2025. Last year's shakeup was highly controversial. I mean, the financial sector, which is traditionally the bedrock of stable dividend funds, got slashed from 17.2% of the fund all the way down to 8.5%.
It was a massive drop.
Huge. And meanwhile, the energy sector skyrocketed from around 12% to a massive 21% allocation. It basically turned SCHD into a heavy energy and consumer staples fund.
And we have to ask why the algorithm built that specific portfolio, because throughout 2024 and leading into that March 2025 reconstitution, energy prices were trending lower.
Right.
Energy companies were seeing their stock prices dip, but because they had built up massive cash reserves during previous boom years, they kept their dividend payouts steady.
Which mathematically forced their dividend yields up. So those energy companies suddenly looked incredibly attractive on the algorithm spreadsheet.
Exactly.
They had high yields, strong historical cash flows, and solid dividend growth history from the previous 5 years. The backward-looking metrics screamed, buy, and the fund just loaded up.
And that heavy energy weighting actually made SCHD an elite performer in early 2026. As the broader market rotated and energy rebounded, the fund rode the wave.
But wait, if that energy-heavy portfolio was crushing it, why would the algorithm suddenly decide to gut the energy sector today?
Because of mean reversion. Historically, energy sits at around 5 to 10% of this fund. That 20% weighting was an anomaly. When those energy stocks rebounded in price, their yields dropped, and their comparative metrics weakened relative to other sectors.
No, so the algorithm essentially forced the fund to sell high. Exactly. The strict rules of the index prevent it from getting too top-heavy in a single volatile sector. That systematic profit-taking is the defining characteristic of today's 2026 reconstitution. 22 stocks were completely removed from the fund.
Yeah, and the Reddit community, our SCHD, they've been tracking the daily metrics for weeks, and their predictions were spot on regarding the casualties.
They usually are pretty close.
Yeah, the energy sector took a massive hit, dropping by about 8%. Huge household names got the boot today. Valero Energy, Halliburton, Ovinitiv. Materials and chemicals also dropped by about 3%, losing names like Packaging Corp of America and CF Industries.
And looking closely at the data from the index methodology reveals the mechanism behind those cuts. Take Valero and Halliburton, for example.
Great companies.
They are. Their stock prices have performed wonderfully, but their dividend growth rate has flatlined. They essentially have 0 years of recent dividend growth. The algorithm has no mercy for stagnant payouts.
Right, if you aren't actively raising the cash you return to shareholders, you lose your competitive edge in the composite ranking.
Precisely.
But look, I have to push back here because this is where the algorithm feels flawed. And it's where retail investors are voicing serious frustration today. 2 massive shockers were removed from the fund, Cisco and AbbVie.
The AbbVie cut surprised a lot of people.
Right. The analyst on YouTube specifically modeled the index rules and predicted AbbVie was a lock to be added to the fund. I mean, AbbVie has a 12-year dividend growth streak, a massive 114% 5-year price return, and a solid 3% yield. It checks every single box on the index methodology.
On paper, yes.
Kicking out a beloved blue-chip healthcare giant with those numbers just makes no logical sense for a dividend investor.
Well, it makes perfect sense when you remember the grading curve. This is the harsh reality of that relative ranking system we talked about. AbbVie didn't violate the 10-year or 5-year rules. It didn't cut its dividend.
But it's not a bad company.
No, not at all. But when matched against the entire universe of U.S. dividend payers on free cash flow to debt and return on equity, newer candidates simply outscored it.
Meaning, like, AbbVie might have scored a 95 on the test, but 100 other companies scored a 96.
Exactly. The competition simply got stiffer. The algorithm has 0 brand loyalty. It doesn't care about AbbVie's pipeline of new drugs or Cisco's legacy in the tech sector.
Right, it's just cold, hard math.
Yeah, if the math dictates you're number 101 on the composite spreadsheet, you are off the team.
Wow. Okay, so let's look at who actually beat them out. With 22 empty seats on the bench, we have 25 new additions filling out the 2026 roster. Who made the cut?
Well, these additions drastically shift the fundamental identity of the fund.
Yeah, we're seeing major additions like healthcare giant United Health Group, Abbott Laboratories, and consumer king Procter& Gamble. Plus, massive tech and consulting names are entering the fold, Qualcomm and Accenture.
And aggregating these 25 additions shows a really clear pivot. Healthcare gets a roughly 4% boost. Technology gets a 3% bump. Consumer staples gets a 2% lift.
So moving away from the cyclical stuff.
Right. The fund is migrating away from cyclical energy and commodities and moving towards stable, resilient growth sectors.
Which perfectly validates the predictions from the analysts over at Motley Fool. They called this sector rotation weeks ago.
They did, yeah.
They noted that the artificial intelligence revolution has essentially lifted all boats in the tech sector. It allowed tech-adjacent companies, which historically aren't really known for paying robust dividends, to build up massive free cash flows, fortify their balance sheets with zero debt, and finally pass the algorithm's strict math test.
And they also correctly predicted that financials would see a modest gain. The financial sector is clawing its way back toward its historical weight with additions like Blackstone and automatic data processing, or ADP.
Yeah, but the addition that really stands out as a fascinating mechanical case study is United Health Group, ticker UNH. The YouTube analysis spent a lot of time on this. The market recently panicked over United Health.
Right, there are a lot of headlines.
Exactly. Between regulatory fears, headline risks, shifting government reimbursement rates, human investors drove the stock price down 37% recently.
And see, human investors see a 37% drop and assume the company is fundamentally broken. They sell on emotion.
But the algorithm ignores the news cycle entirely. It simply looks at the ledger. It sees a blue-chip healthcare giant with a 16-year consecutive dividend growth streak.
And because the price dropped 37%.
The dividend yield spiked to a mathematically attractive 3%. The cash flow to debt ratio remains stellar. The machine essentially went bargain hunting, buying a high-quality asset while human panic put it on sale.
It's forced discipline, which raises a critical question for you, the listener. If you are holding SCHD in your portfolio, how does this massive 2026 reconstitution actually affect your bottom line?
Right, the million-dollar question. What happens to the actual dividend payout? By swapping out high-yielding, highly volatile energy stocks for more stable, consistently growing healthcare and tech names, will the yield change?
We will likely see a slight recalibration of the raw yield percentage. It might tick down slightly.
Okay.
However, the underlying safety and the long-term growth rate of that dividend have theoretically been fortified. You're trading a fraction of a percent in current yield for a significant upgrade in future stability and compounding growth.
Which really highlights the deep philosophical split between the financial communities reacting to this news today. I mean, the analyst sentiment completely depends on what kind of investor you are.
It's the classic active versus passive debate.
Literally. The Motley Fool's official stance right now actively recommends against buying SCHD. Their entire philosophy is built on active stock picking and chasing alpha.
They want you to beat the market.
Yeah, they want you to buy their top 10 stocks to buy now, because they're hunting for the next Nvidia or Netflix before it explodes.
Okay.
They view a ridded, slow-moving, algorithm-based ETF as an anchor on your potential growth.
But contrast that with the sentiment across the RSCHD subreddit and the dividend investing YouTube channels.
Oh, it's night and day. To that community, SCHD is the ultimate buy and hold forever vehicle. One user on Reddit explicitly pointed out that you don't buy this fund for short-term price momentum.
No, not at all.
The entire consensus is built around long-term share value through the dividend snowball effect. You buy the shares, you automatically reinvest the dividends to buy more shares, the payout grows organically every year, and you completely ignore the daily stock price fluctuations.
And for an investor utilizing that snowball strategy, today's reconstitution is a massive feature, not a bug.
It did the work for them.
Exactly. The algorithm did the heavy lifting of portfolio management for them. It cleaned out the stagnant dividend payers and refreshed the portfolio with growing ones. There is, however, a crucial mechanical detail regarding taxes that anyone holding this fund must factor in today.
Right, because nobody likes a surprise tax bill.
Mm-hmm.
Because the fund just sold 22 stocks and bought 25 new ones, it realized capital gains on the stocks it sold.
And the rules of ETFs dictate that those gains must be distributed to the shareholders.
Yeah, so if you hold SCHD in a tax-advantaged account like an IRA or a 401k, you're entirely shielded from this. You don't have to worry.
But for those holding it in a standard taxable brokerage account, you need to be prepared for minor capital gains distributions this year.
Now, Index funds are remarkably efficient at minimizing these taxes through a process called in-kind transfers. So the tax hit shouldn't be catastrophic, but it is a real-world consequence of a 25% portfolio turnover. Wait, hold on. In-kind transfers. How does that actually prevent a tax hit when the fund is dumping 22 stocks?
It's pretty clever. When an ETF needs to remove a stock like Valero, the portfolio managers don't just log into a brokerage account and hit sell, which would trigger a massive direct taxable event for the fund.
Right, that would be a disaster.
Instead, they use an institutional barter system. They hand a basket of the underlying stocks they want to get rid of to large institutional investors known as authorized participants. In exchange, the authorized participant gives the fund manager shares of the ETF itself.
Oh, so because they're swapping shares for shares, and actual cash never changes hands, it doesn't hit the fund's ledger as a realized capital gain in the traditional sense.
Exactly. It dramatically minimizes the taxable footprint of the turnover. It won't eliminate the tax burden entirely given the sheer volume of today's changes, but it prevents a massive tax bomb from hitting the retail investor.
That is fascinating. So to synthesize the madness of today's market shift, the 2026 SCHD reconstitution effectively traded out its heavy, volatile energy exposure for a much more balanced, resilient mix of healthcare, technology, and consumer goods.
Yeah, the algorithm did exactly what it was programmed to do.
Yeah, it removed human emotion, ignored the panic around stocks like United Health, created the entire market on a harsh curve, and built a 100-stock portfolio optimized for safe, growing cash flow.
It really is a masterclass in systematic investing, but, it also raises an important question to mull over as you review your own portfolio today.
Oh, yeah. What's that?
Well, we've established that this rules-based algorithm ruthlessly cuts companies the second their dividend growth metrics slip. It relies entirely on a rigid 5 to 10-year historical track record. It only looks backward.
Right.
In an era where artificial intelligence and rapid technological shifts are transforming entire industries overnight, is looking backward at a 10-year track record the safest way to predict a company's future payouts? Or does a rigid backward-looking machine risk leaving you one step behind the actual market?
That is a phenomenal question to end on. Thank you for joining us on this deep dive into the 2026 SCHD reconstitution. Take a look at your own portfolios, see how these sector shifts align with your personal financial goals, and decide for yourself if you trust the machine. Keep learning, keep questioning, and we will see you on the next deep dive.